investment. We had roughly $6 billion worth of investment in the multifamily sector in Phoenix. Average price per unit skyrocketed to $147,000 per unit. That's up from $114,000 in 2017. That's a nearly 30% increase. Put against office, retail, industrial, cap rates are the tightest in the multifamily sector by a wide margin, no surprise. Despite outsized rent growth, cap rates compressed under 6% in 2018 as prices appreciated by nearly 30%. Last time cap rates were under 6% in Phoenix was 2006. All right, panel.
Thank you. We have a lot to go over today, so we'll try to condense and talk really fast. So we have a great panel today. Next to me is Ashton Gunter.
Asher.
I say that every time.
That's okay.
Yeah, sorry about that. With CBRE, has a lot to say and talk with us about and share some updates in addition to what we just heard. I have Chapin Bell with PB Bell. It's representing as our developer and property management company. And Nicole Ray with Greystar, managing operations for over 22,000 units. And overall, Greystar manages throughout the nation?
In the United States, about 430,000 units.
Internationally,
almost 500,000.
Just a little bit of units there.
That's a few.
This is fantastic. Well, here's what I thought. You know, if in multifamily, we have a lot to do with ratings and reviews, right? So everything that we do and talk about is ratings and reviews. So the new thing that's coming is we're going to start rating you too. So that's how it goes. It goes around in circles. So give us high fives and we'll give you high fives back. So the first question today, we're going to talk a little bit about how's our economy doing as far as the multifamily. I mean, most of us know we've had a really exceptional year, but how exceptional is it?
We may take a first shot. Okay. Hi, Asher Gunter. I'm with CBRE's Multifamily Institutional Group, and we have a benefit of seeing not only Phoenix, but most markets in the West. Our team is the most active multifamily team in the Western United States. And so we sell properties in not only Phoenix, but Vegas and Denver and SoCal, etc. Phoenix is doing phenomenally well. Fundamentals are driving Phoenix right now. We've heard a lot of that. Great story with jobs increasing, 86,000 new jobs year over year. Overall, it's the types of jobs that are getting people excited this time around. If you look at the last cycle going into 05, 06, 07, we had similar job numbers, but a third of that was coming from construction. And you saw, if you really study the jobs that are coming in today, it's financial services heavily, driven by people migrating out of the high-cost states into a very affordable market. It is the cheapest place to be in the West and has great infrastructure. So the types of jobs are different. We still have a large retirement community coming into Phoenix as well, a lot of medical. And then the technology, we really are the back office to the Bay Area, San Jose, etc. So they get 200 jobs in San Jose, we get 2,000 jobs here, sales, marketing, etc. That trend is continuing. It's still, this market is the cheapest market to rent in the entire West. Maybe exclude Las Vegas from that, but we're right there. Las Vegas, from a multifamily perspective, is a very different market than Phoenix. Certainly, infrastructure and types of people there. The trends we're seeing as well, it's young people moving to Phoenix. If you look at what's happening right now, that 20 to 34-year-old band, which is your largest renter section of the population, we are either number one or tied for number one in the country of all the major markets for net in-migration from that population segment. So that's good. Population growth has always been good. Now we're back to historical levels. north of 100,000. CBRE is projecting through 2026 that this population growth that we're experiencing right now is going to lead to about 47 to 48,000 new households created each year through 2026. So that's your demand. Household formation is your demand. Now overlay that with what we have in terms of construction. Single family, 22,000 homes maybe delivered last year. Condos are still a four-letter word in this market. They really haven't come back. And then multifamily is about 8,000 units that we delivered in 2018. So you got demand of 47,000. You got supply of about 30,000 to maybe 35,000 units. And that's why our vacancy continues to decline year over year. Class A, Class B, we were one of the few markets in the West to see occupancy increases and strong rent growth. So, the millennials are growing up.
Yeah. And what about cap rates right now? What are you seeing?
We focus on Class A, Class B, and cap rates have held steady. We had a large uptick in interest rates last year, but cap rates really are driven by anticipated rent growth, right? And this market has a lot of anticipated rent growth. So we saw cap rates start the year in the 4.75 range, and we ended the year in the 4.75 range on Class A, Class B. You think about that. If you're buying a 4.75, you go, okay, I'm buying sub 5, but if I'm getting 5% rent growth, by the time you get to the end of your first year, you're already north of a 5 return. And you compare that to a lot of the coastal gateway markets. That's a pretty healthy and attractive return. Another note to make on Phoenix from an investment standpoint is across the country, Phoenix was the top performing market in overall return for multifamily at about 15%. So that was NACRE returns year over year.
So how does that look from a development side? I know from your strategies from 2017 to 2018, really 2018 to 2019, have they changed at all?
Yeah, we focused on, as everybody did, really a lot of infill project. If you look over the last 5 years of cycle, probably 70% or more of the new product that was built an infill, which is downtown Phoenix, Tempe, North Scottsdale, or Old Town Scottsdale. And that's where people wanted to be. But as Elliot talked about this morning, there's still an affordability issue, and where construction costs have gone, which have gone up significantly, and in the last panel they talked about 10%. We probably saw a 15% increase in construction costs over the last year. It's getting more difficult to build buildings where you can create that affordability. So our strategy has really moved away from focusing on downtown location, infill locations, because you need rents that are north of $2 a foot, $2.25 a foot to get those built. And we're focused more on the suburban markets. So we're building some projects in Gilbert, we're building some stuff in Goodyear, Avondale, because you can still build a product there where you can get rents, as Elliot said, if you can get them between $1.40 and $1.65 a foot, that's still within that workhouse housing kind of renter. So we're focusing on that, and as it relates to kind of the economics, we're seeing better rent growth in those markets than we are in the central quarter, just because there's a lot of inventory, and we think those rents are somewhat capped in how much growth you can do in those if you're already over $2 a foot. So that's really where the strategy's changed.
And just to follow up, if you are looking at what you're building now in those suburban areas, are you looking at all at walkability factors? Are you looking at mixed use, or just the traditional garden?
Yeah, I mean, again, when you're in the suburban areas, you don't have as many of those opportunities to build walkability. I mean, you're not building. If you're building downtown, where you can walk through your office, walk through retail. I mean, we're doing some stuff. We look at demand drivers, and you want to be close to retail, you want to be close to jobs, you want to be close to transportation corridors. So we've got a couple sites where we're next to some retail centers, and we're not next to Desert Ridge or some of the or Scottsdale Fashion Square, but you know, you got a couple restaurants and grocery stores and that type of thing. But when it's, you know, it's harder to get those products. So we're focusing more on the design of the product itself and the amenities within the community, you know, so still continue to focus on robust exercise room, dog parks, dog walk stations, all those kind of things that residents today want to have.
All right, and a funny question to ask a developer, but do you really think we have overbuilt at all?
Well, I'm a developer, so absolutely not. No, I mean, again, I think, you know, everything we've built has been absorbed, and what Asher said, I mean, again, you look at the demand, you look at some of the comments that, you know, Elliot said today with, you know, millennials, you know, they're starting families later. There's still a whole bunch of pent-up demand of millennials living at home with their parents. So, again, you know, you have pockets of submarkets that you know see some softening where there might be more concessions. Velocities may go slow, but ultimately it's all getting absorbed because everything we talked about today. And the suburban product, you know, those we're seeing, you know, absorption very attractive, no concessions and so forth too. So I don't feel we're overbuilt. And you look at our pipeline, that's coming down a little bit, and it's coming down because there's some governors. I mean, it's harder. Construction costs are having an impact on penciling, getting deals to pencil. You know, cities are thinking that we've built so many apartments, so cities are starting to push back and getting stuff zoned. So, you know, I think we're in pretty good shape.
We're hoping for that too. Now, this year seemed to be a really great year for transactions in 2018. And how did that exactly affect Greystar for the year?
Well, I could, you know, easily say our transaction volume, you know, pretty much doubled. I think, you know, and Asher probably knows my numbers better than I do. 2017, we probably brought in maybe a total of 15, 17 gross ads. 2018, we brought in 34 gross ads. Now, you know, as it shakes out, 34 came in and 29 went out. And it's so double the amount on both sides. You know, really, you know, in my career, I've never seen anything like it.
We noticed that as well, and I was at a meeting at IREM nationally, and I think that's also something that's happening. Because we were talking about in the last 3 years of a company that we managed roughly 23,000 units. So if you think the last 3 years, we had out and in about 4,500 units a year. That's a lot of properties being sold and being brought back in. It's like that little gerbil on the wheel for property managers, especially if you're a fee manager. Different for the owner-developer, and you both are as well. So you have a little bit of both.
Greystar of the 34, Greystar purchased 5, and it was in the last 6 months of the year that we purchased all 5. So, and that's a big entrance for a company like Greystar that I'll go ahead and say, you know, a little shy on Phoenix these last couple of years. And we're poking them, and all of a sudden it's like, you know, the eyes brighten up and it's like it's time to move. That's the feel that I had in 2018. It was almost like the pulse out there was pretty exciting. So, and that you know, that crosses all, you know, a number of product types, but just overall, you know, the deal volume itself just.
Right. We were talking a little bit about the types of transactions that happen and how aggressive some of the buyers were being. And now we have a pro forma as property managers. How does that look?
Well, you know, from start to finish, and I will say it wasn't that long ago that we'd get a phone call, hey, we were awarded a deal, want to do a DD, you know, a 30-day DD, can we get started next week? Yeah. Sure, no problem. Now the phone call is, I have a 5-day DD and I'm going hard next Monday. Can you do it? The answer is absolutely yes, but it creates this fervor out there. Try doing that 34 times in 12 months. You know, but so that fervor, right? Actually, like if you want a deal, you've got to move. And in order to win the deal, those numbers need to be aggressive. So yes, there is, aggressive underwriting out there, but really you still feel overall that, and the last speaker's talking about the runway is still, I think, really wide and clear because, they just, whether it's the renovation world, the development world, it just keeps coming and they keep accepting, renovation rates going up. Second, third round renovations. Absorption of those keeps coming. Average occupancy, 95, 96 is very common these days. So,
and taking over properties. With that said, you have the renovation 2.0 and the renovation 3.0, and now about the third name.
right.
And we were talking about
the classic, the gold, the platinum, the diamond.
yes, sir.
Keeps moving.
Yes. And with that, we were talking about how about these market surveys that we're doing in the industry, and we'd like to talk to you too, Asher. If we're looking at market surveys, the traditional market survey, and we have so many different product types. We have premiums, we have renovations, the diamond level, the platinum level, I love the standard. What is that?
Classic?
Yes, classic.
With a smile?
It's the right run. Yeah. That's
Entry level.
Entry level. So with that, how are you really getting the rates? If we're doing, we're talking and we're doing the due diligence and we're trying to get some really good, solid numbers to make sure that the performa numbers work. How are we doing that?
Well, it's definitely, they're pretty complex now, and our clients depend on that information being accurate. And so, you can look at a market survey, and really, in speaking to the renovation world, but the renovation world also is bumping into the Class A lease-ups sometimes because, the bar is getting raised higher and higher. They're looking pretty slick, and so now all of a sudden you can look at a market survey easily and see product ranging anywhere from the early 2000s all the way up until 2017, and it is competition. So, for us, dissecting the market surveys, making sure that we're looking at diamond, gold, platinum, that they're broken out, dissected so that you can see not only what the market rate looks like, but what the premium level difference is between these renovation second and third round. So it's not only that, but it's also, I find, as in the old days when you went and got a book this thick and looked at all the competitors, these days digital marketing is the marketplace, because especially in the A-class world, you're competing with anyone in town. If you're looking for rents at $2 a square foot, you're looking in South Scottsdale, North Scottsdale, downtown Phoenix, in the Midtown corridor. So, and that's where our customer, we've got, I believe, really great transit, and so they're willing to go from Midtown to South Scottsdale or even North Tempe. So it's getting tougher to provide the right information, but it's more important than ever.
Asher, when you're looking at the face of the buyer from years past, what did 2018 look like?
Well, 2018 was a record year for the metro area. I mean, we had we focus 100 units or more type transactions. The whole market traded about 130, 140 deals, and that was about $5.8 billion for the market, which just speaks to the transition and the management. There were a couple of themes this year that happened. We saw a lot of the opportunity funds cycling out, and that's just simply cost of capital. They were the early buyers in the market 2012 through 2014. Prices were lower. So they're your 18 to 20 IRR cost of capital. So we we sold portfolios last year for Brookfield and Blackstone and AllianceBernstein, Oaktree, big hedge fund cost of capital, and they're just really cycling out and profit taking. They can't be a buyer of multifamily anymore. They've got to find something else, and if they're not a buyer, they're a seller. So we saw quite a bit of that. I think you'll still see a little bit more of that. DRA was another one that moved out of the market with their position. The market is transitioned now. I mean, if you looked at 2014, 70+% of our buyers were private capital. Last year, private capital was maybe a little bit over 50% of the market total. Institutional capital rolling in, which was your open-ended funds, your closed-end discretionary vehicles, the REITs accounted for over 30%, probably getting close to 40% of the acquisitions last year in this market, and a very different cost of capital. And so you're seeing that institutional interest really come to Phoenix, and they're not, it is a cheaper cost of capital, but they're not dumb. They're coming here for a reason, and they look at things. We're constantly being compared versus a Dallas or a Denver or a Bay Area or SoCal. And they're just looking at it going, where is the growth going to be over the next 5 to 10 years? And what is the best risk-adjusted return that we can get at this point in the cycle? And so if you're looking in, the Inland Empire and the average rent there is $2,000 a month, and then you come here and look at the exact same or better quality product, better quality location, and that's $1,500 a month, $1,600 a month. You go, Phoenix is a value. We need to be in Phoenix, and that's what's driving the growth. So, the themes are we're getting better quality capital, better buyers here. They're spending money. They're investing in the real estate because they think there's lift in the rents. There is lift in the rents, and they see the job growth stories, and I think we're also seeing a bit of a theme from the flippers, maybe, which was your 2012 to 2015. We probably had that kind of impacts all these levels of renovation, right? We started with 2012. They were all classics, so they upgraded to gold. And then the gold sold 14, and then they upgraded to the platinum, and now the platinums have sold. So it's just a migration up, and I think we're shifting toward a little bit more longer-term holders right now at this point.
So with that, construction costs, highest rents that are going on right now, and we've talked about the lift that you could get for renovations, because most I see put in, let's get 150 for the renovation, like 150 or above. I want to go back to you though, Chapin, real quick. We were talking about how expensive labor is, construction costs. We were talking as a management company, most are seeing about 10%, I would say at a certain size, 10% of vacant positions, mostly maintenance techs. And some of our supervisors left to go into the construction field or maintenance techs because of that bonus or whatever they do to get them. And so we're trying to figure out new ways to bring in recruiting people. But back to construction costs again, you have to put that in. We have tariffs. We have the government question where you were talking about granite versus quartz, appliances. Talk a little bit about that. I think that was pretty interesting.
Sure, yeah. I mean, we have to deal with costs in a lot of different ways. I mean, it's not just in the cost of the physical construction, but it's the delays we have to deal with because of labor. So, we've seen, and it depends on the type of product that you're building as well. I mean, if we're building a stick frame surface park property, last year we talked about 15%. If you're building a podium parking style product, you're going to see a bigger increase in that. I mean, the cost to build a parking structure has gone, just last year went up 30% because the cost of labor, the cost of steel, the cost of concrete. So, that definitely has an impact. But as a result of the labor shortage, we're seeing, we used to be able to open a building up in 10 to 12 months. Now that same building, and I'm talking garden because higher density is going to take longer to open, but today it's 14 to 16 months. So as a result of those delays, you got more interest carry, you've got staffing issues you got to deal with and so forth. So it's not just the cost of construction. Then now we've got the tariff issue. 300% tariff on quartz. So now we got to make sure you use granite and those type of things. But we are getting some lumber prices are down, so that's having a positive impact. But we're still into our performance right now, we're still putting 1% increase in costs a month. So when we're building a deal, it takes us a year to start construction. So, we're at 10 to 12% more in costs based upon today's costs, and hopefully we'll get through some of this government issues, and some of those tariffs will come down. We can bring some of those costs down, but that is definitely a struggle.
And the difference between the cost per square foot for infill to the cost per square foot for suburban?
Yeah, again, it depends on the product. We're building today on a cost per square foot just for construction costs. We're probably $130 to $135 a foot for a suburban product if we're building an infill product. And again, it depends what type of parking structure you're building, but that's going to be $225 a foot or more depending on what you're doing. So again, that right there shows you the difference between what kind of rents you need to get between the two product types.
Yeah, and we talked a little bit, I think, $225 per square foot for infill. I've seen them up to $275, and then on the outskirts, it's a lot less. So you're at $1,400 a month, like on rents.
Sure.
So from infill to suburban, I know. How does Midtown look right now?
Asher could probably say off the top, what, $170?
It's probably right on
80?
on the contract rate right now.
A little harder to lease on the infill?
Massive absorption, I think. It's just that, you've got supply, and there's a lot of reasons for having supply in those markets because it's really dynamic and a lot of things are changing there. But you have all that supply coming on at one time. You've got concessions right now. So
I
it's
see
a little
little,
more competitive.
you continue to experience little ripples, but that's what they feel like now versus the last go around.
We don't have a supply issue like some other markets have a supply issue.
And the jobs keep coming.
Right. So how about these opportunity zones?
Boy,
Governor
Jamie, you
Ducey,
wanna-
maybe.
Now we're all listening.
Are we seeing opportunity in the opportunity zones?
Yeah, with opportunity zone, that's kind of the buzzwords now, and I think where it really benefits is there's a lot of capital running to that, and people aren't aware. Basically, it's a way to take your capital gains and not have to pay taxes on them if there's a lot of criteria, but it's just not real estate. You could sell an airplane and have the capital gains on an airplane. You could invest in these opportunity zones, and so it was a way to spur the economy, but for a developer, it's not. It's more difficult because to get the full benefit, you got to hold in 15 years. And if we don't have capital gains, we're not going to get any benefit from those opportunity zones. But there's a lot of capital chasing those, chasing those opportunity zone investments. And again, it's not. You got to be in a zone where it is. So there's heat maps that show where they are, and there's some places you want to develop, some places you don't. But it's kind of the buzzword today.
People still have to want to live in that place. So as apartments.
So what is the best area? I think we all probably know that. But the next question, what's the best area rent-wise, vacancy-wise, still North Scottsdale, downtown? What is it?
Well, it depends if you're a renter or you're a owner.
Yeah.
But again, the Phoenix metropolitan area, there's so many places that are great to live. Not everybody wants to live in downtown Phoenix or downtown Tempe and live in a 600 square foot one bedroom. There's still people that want to live in Glendale in a 900 square foot one bedroom, and they don't take their dog out and so forth too. So you heard a lot of the panels today on where your growth is. If it's areas that 5 years ago we wouldn't consider. So we're looking at sites today everywhere. We're not necessarily focused on I-17 corridor between 45th Avenue and 19th Avenue and Metro Center. That's not an area we're necessarily focused on, but actually we're in Gilbert, we're in Avondale, we're in Goodyear, we're in Chandler, we're in Mesa, So there's so many places we want to be because there's so many places. We're just following where our potential renters want to be. So there's just a lot of people have different lifestyles.
I think Chapin's leading on there. He's ahead of the curve on where capital wants to be too right now. The theme was infill. We've got to find the millennials. And so everybody wanted a nice new urban wrap or podium deal. And to what your comment was earlier was walkability, right? And that has shifted in the last 18 to 24 months with